Hi, this is Helen Tarrant. Hi, this is Helen Tarrant. Welcome to Commercial Property Roadshow. Today I'm going to show you this part 2 of this sequence of different property deals, and this is going to be about a partial uplift. So this is a simple deal. Look, it's not the easiest deal to find, but there are deals out there where you might come across a vendor that is not the best vendor to deal with. You might find it a bit tricky situation where you have to renegotiate some leases. There's things coming in that hasn't happened yet but will happen next 3 or 4 months, and there may be some cosmetic changes you need to do for that property. That's all what I call a simple uplift deal, where you've got some good holding income already. The income is temporary, but if you can service it, you can actually make it long term and really tweak that property and increase the value. So let's check it out, and I'll see you after the video.
Now, the second deal is a little bit interesting because it's the vendor is deluded, I have to say, in one sense, because he thinks the tenant is really, really happy, and the tenant is happy there in the location. They're just not happy with him as a landlord. But he actually thinks that they are happy tenants. In fact, he wrote us an email today to say, don't talk to my happy tenants until you settle on the property. And we're like, you know that the tenant actually don't like you. But anyway.
No one wants to be told that as a tenant that they're not liked, right?
Yeah. And I was saying this to the agent. The agent goes, I can't tell him that, though. So anyway, this deal is interesting because 266 Charters Towers Road is in it's a main commercial strip of Townsville, and it's across the road from 268 Charters Towers Road, which is the next case study we're going to talk about. Now, 266 is an uplift deal, so is 268, but they're fundamentally different uplift deals. Now, this is where I call a more of a safe but a patient uplift deal, which means that when you buy the property, you have to accept a lower yield going in with a higher yield in the back end, but you have to actually patiently wait out till the renewal of the lease or until you settle on the property before you can actually do anything with it. And which means that as much as I want to go in and go, I want to renegotiate a new lease, I want to talk to my tenants, make sure they're happy, do any of the works they want, fix anything up, you can't. Because the vendor actually knows what he's selling. I mean, there's certain times you stumble on things where the vendor has no idea or it's a headache and they just want it gone. But the vendor actually knows exactly what he's selling, and he knows what's in the back end, and he's willing to sell it because he's got other projects on the go. But he's giving us restrictions that he's only giving you an unconditional contract. So it's not going to be subject to due diligence because he particularly don't want you to talk to the tenant, because he knows that the longer we leave the tenant, the longer it is likely for them to renew the lease. Now, that's a different approach to us. We rather just be upfront and say to the tenant, hey, your lease is coming up in March next year. What would you like done for us to be able to get you to stay and take up a new lease? For him, it's like, let's just wait till February and say, hey, you've got a renewal next month. You've got nowhere else to move, so you better take up the option. We're not an advocate of treating our tenants like idiots. So
that's a bit harsh.
Yeah. Yes. And then you can see why there's
never
that
treat your tenant like an idiot, because the tenants are really knowledgeable.
Yes.
Yes,
exactly.
we have ways of making you stay. Yeah.
So anyway, let's go through this so I can explain where this property kind of sits. All right. Screen, please. Thank you. All right. So 266 Charters Towers Road. And we've had many discussions. I've had many discussions with the vendor and by the agent, of course. And it has been very challenging. But essentially, it is a property that is 100% leased. There is 2 tenants downstairs. There is a residential real estate agent, and there's Clarity Hearing as the other tenant.
What? Thank you.
So it's in a flood-free area. It's a corner allotment. It's very close to the major roads. It's got great passing traffic. It's about $97,000 in terms of a net rent. Now, there's probably a little bit of variance to that. and you have to and we always verify that through due diligence. But just essentially for you to have a look at where that is. So we've got Clarity Hearing, and then we've got the real estate agent there. So there is standalone building, mixed use zonage, which allows you, meaning that you can put any kind of tenant in there as well. So you can see here, Clarity doesn't have any more options coming up, and they're about 52%, and they're 46%. So that's the total rent, their outgoings, and outgoings, total recoverable outgoings. So it's pretty much, you've got long-term tenants. It's been there for a long time. The Clarity Hearing people have just recently this year spent $35,000 and created disability access and disability toilet at the back. So I don't think they're actually going anywhere. I don't even think that if you started the negotiations with them this early, it would have impact on it. But because you're a third party to a deal, you cannot go and just talk to the tenant without the vendor's permission, because they're a third party to the deal. They don't have to answer your questions, and obviously with the vendor, it's their tenant, so it is their right to refuse, and you have to make a decision whether you will continue on with your due diligence or whether you will. For you, it's essential to talk to the tenants. For us, depending on the tenant, depending on their history, some tenants, we would say, look, we think they're not happy, we think they might move, then we would, definitely want to talk to them. Some tenants, we know that they're probably going to stay put, and they probably won't be able to get out of their lease, or they don't want to because of what they've done in the last 12 months or two years and how their business is tracking. Then, for us, it's irrelevant. So it's a case-by-case situation. Now, just to take you through some more stuff. So there's just some photos of the property, and so you get to see the property at the back. Clarity Hearing, very neat Allied Health tenant. Carries herself a disclaimer, and we've got
The rates notice.
rates notice. So we've got a rates notice, and we're looking at assessment rate. Let's see is there a value on this? Yes, is there a value? Oh, there's no land value. No, there's no land value on this one. Maybe it's at the back.
Maybe it's free.
No, so the valuation is $255,000. So if you're buying this in an entity, you would be by itself, you will be under the threshold, and so therefore, there will be no land tax applicable. We've got the tax invoice for, I believe that is the insurance as well, so that you could compare insurance. And then we've got a diagram, lease A and B.
There you go.
So that's the type of property. So with that type of property, this is the type of property that, and also there is another added layer to this property. On the front of the building, which I don't think we can see from the IM, but I'll just scroll through to see if we can see that in front of the building.
There we go.
Okay, so it's more. So there's going to be a digital billboard that's going to be built and sitting on top of there, on the corner of that building. Now, the digital billboard for this property has been approved by DA, but has not been installed yet. It's going to be $10,000 a year. And they've signed a lease for 10 years. So even though they haven't started, and that will kick off next year as well. So if you look at this property, when you're buying into this property, there is a lot of back end, but the back end actually requires you to negotiate the lease and actually wait out to the end of that lease. So where the vendor says you can't talk to the tenant, but you know that you've got the real estate agent that's still got a couple of years to run, You've got with options as well, you've got the Clarity Hearing who've built the disabled toilet at the back and the disabled access, and they are quite busy and stable in that time, so that you'll find that, in March or when you go unconditional, you're most likely to be able to negotiate with the tenant. So I would suggest that, and then plus you've got the $10,000 on top. So all in all, by the time you add up the actual income of that property, it's going to be somewhere around $107,000. Now, this deal is what I would consider a entry level to Uplift deal, because it doesn't require you to do any refurbishments. It doesn't require you to go and to cut up the premise, do anything else. It doesn't require you to repair anything. It's purely a lease negotiation with the tenant. And in a market where you have multi-tenanted property with someone with a quality like an allied health tenant, and we talked about how much the yield is normally in a town like that, about 8.5%, you're looking at a property that will have 3 streams of income when it's next year in March. So you'll have the real estate agent still there. And if the real estate agent is not there, you can see that with that property, because it's a corner position and they've got allied health next door and they've got a plaza next door as well, and the corner position, you can actually quite easily attract an allied health type of tenant in there purely because of that location of that property and that exposure of that as well. So it's not something to be worried about in terms of security and that location. So some things to look for when you are looking at Uplift deals is versatility of the property, right? That exposure, what else can you do? What else can you put in there? The quality of the property itself in terms of the fit out and what the tenant has done. You can look at it, most things are very neat, tidy and beautifully fitted out. We haven't done a pest and building report on this, so I can't tell you exactly if the roof or anything, those things needed to be repaired. But, adding a billboard on top of this, you've got 3 layers of income. 3 layers of income on a property that is just over $1 million will put this property into the realm of 1.2, 1.3 million. So if you bought this property for early 1 mil, you'll actually have about $150,000 in equity in the back end as well.
Don't forget, 3 levels of income. Also split your risk 3 times. So straight away, you're, diversifying your income, and, should a tenant get into trouble, or should there be a scenario where they vacate, you're not totally exposed.
Yeah. So if you bought this property in now for, let's say, 1.1 mil, you would, this property itself will not give you the 9% yield that you would normally get in Townsville, close to that. But what it will do is it will give you short leases. So for a property like this, if you have a servicing issue, you won't be able to buy this because of the short lease term. You'll have to actually be able to service this deal on its own. Even though there is a back end to it, you can always wait for the back end to come and eventuate and then look at, okay, can I refinance? Can I pull out some more money out of this deal? What can I do to make, to bring some of that equity back down? You can do all of those things. But right now, when you first go to the bank with this, the bank is going to be looking at you for servicing. So if you don't have a servicing position and your serviceability tapped out in your portfolio is negative, you can't do this deal. So this is the difference between this deal and the Adalia deal, where that one, it doesn't matter who you are, the bank will lend to you. Whether you're in your 70s or whether you're in your 20s, they'll still lend it to you purely because the deal itself. This deal for the bank is a complication because they know that, yes, there is an established history. The tenant's been there for a long, long time. Yes, there's likely to be a new source of income, but they can't count that income until it's coming in the bank. So all they can count on is the income coming from Clarity, the income coming from the real estate agent, and the shortness of the lease reduces the WALE, or the average weighted lease for the property. And as a result of that, they're going to be looking for you for some security because the security of that diminishes. So for you, if you're looking at an Uplift deal and your entry point into an Uplift deal, your mindset has to have a level of risk tolerance. You're not going to be able to come into this deal and say, I want to renegotiate the lease. Well, that's not an option.
No.
I want to, I want to make sure that, I want to do uplifts to the back end of this property. That's not an option. There's parking for the tenant. There's some sheds for tenants to put things in. Both tenants have the whole of the property. They share the parking space at the back. you're not going to able to do anything with it. This is a purely wait for the lease to roll over, renegotiate leases. So you would have a new 3 years or 5 year lease to be matched with I would even next year at some point go to the real estate agent, get them to extend their lease. And then I would have maybe 2 tenants on new 3 year leases or 5 year leases, plus a billboard on 10 years. And all of a sudden I have a property that I've de-risked. And when I take that property back to the bank, it is a property that is of much, much higher value. But in order for you to get in the door, you actually have to have servicing, which means that, and also the mindset to do it. And the mindset behind this is I got to be able to tolerate if I lose a tenant. Yes, there's probably a minute chance. There's probably, 5% chance you might lose a tenant, or possibly even 10% chance of losing that tenant. But I know that if I had the billboard in place and I had the real estate agent in place, which they are both on leases coming up, I will still be able to service my debt and have positive cash flow, but I will be able to deal with that vacancy should Clarity Hearing leave. And
does that answer, because we saw that Nicola asked a similar question with regards to what would the banks think about the deal compared. Does that, Nicola, answer your question?
Yeah. So when you compare the deal, the bank is going to look at this as risk, and they're going to look at you for servicing. So for you, you're going into this mindset that this deal will not be perfect. You have to take the deal as is. If you're buying a set and forget deal like a Dahlia, that kind of deal comes as a set and forget deal. So everything in that property, when we do the due diligence, has to tick off. We have to say, yes, there has been no leaks in the property. Yes, the property has been fitted out properly. Yes, the tenant has paid rent every time, on time, every month. Yes, they've been trading well. Yes, they've done all of these things have to tick off. Now with this deal, yes, look, there might be some issues with the roof. Well, fine, but you're going to have to take it. That's just part and parcel of it. Yes, you can't build at the back. That's what it is. You can't, you have to wait out to negotiate with your tenant. That's the nature of it. So that's about having a little bit more patience, and also,
certainly not a deal for you.
Which is not, no, I don't. So I've been trying to push for the last month all the different ways how we can approach the tenant without pissing off the vendor. And we're talking to the agent to saying, can we do this? Can we do this? Can we just rock up one day? Can I send Renee in one day and just have
Can you find out when their birthday is? Yeah. Happy birthday! Sign the lease.
And, I've been saying, well, now you've got 4 girls. Surely one of them has some hearing issues. Can you please take one of them in?
Great.
So,
yeah.
So
nothing quite like a webinar to get yourself on the front page of the BRW.
Yes,
Yeah, no.
No, so this is the thing that, I've been trying to work with the agent. So would he give us, subject to valuation at least, if he's giving us an unconditional contract? So we've been trying to push the envelope either way. And a deal like this do take longer to negotiate. A deal like a Dahlia is you read the IM, you read the lease. That's great. Let's make an offer. That's it. And it's either yes or no on the offer. And you just come to a price and a yield that matches to you. With this property, you got to work with the vendor. You got to work with the vendor, you got to work with the agent, you got to work with the tenant, you got to work around a lot of things. And a deal like this takes much, much longer to put together.
And a lot more patience.
A lot more patience.
No.
Yes. So
now, the lovely Bowman is asking, what rent uplift would you expect in March next year?
Well, the tenant itself it's more we're going to get the $10,000 from the billboard, which is not included at the moment because it's not in at the moment. And then with the tenant re-signing the lease is actually the security of it that is going to give the reduction in the return. So what that means is that because they're signing a new lease, it's going to be now makes the property worth more.
Sure. So not necessarily that much of a rent uplift, but more of a value uplift because we've got a stronger lease, reducing the amount of risk, and therefore anybody looking to buy this will go, okay, now it's more like a Dahlia deal where they can go in and say, all right, we've now got a long lease, and then the bank will probably look at it as a
that's
a lease
exactly
doc.
So
that's the whole purpose of it.
And that's exactly where we're going to be talking about next, guys, with the extracting value.
Yes. With market reviews, is there any risk the tenant wanting less rent?
With this property, if you were to get, my suggestion with this is you just keep the rent as is, but you would give them a few months rent free. So you probably take a hit on a few months, but in the long term of it, you would just take the months rent free, but you'll keep the rent at the same level.
Cool.
Yeah. So this is your introduction to really Uplift, and your mindset really have to go in and goes, look, there are going to be deficiencies in this property. It's not going to be all good, but I'm willing to proceed because I can tolerate that level of risk with that. Yeah. And that's really part and parcel of it.
Yeah.
So hopefully you've enjoyed that. That's number 2 of the 3 in the 3 parts. So join me next week when I show you the third one, which is the full uplift. How would you treat a full uplift property? The things you have to do, the mindset you have to be around it. See, now you've experienced, set and forget properties where you just basically buy it complete and the money comes in and it basically needs to plug any of the things that is negatively geared in your portfolio and make it positive. Now with the partial uplift, you've got some income, but the income's not stable, but it's about how you engineer that stability over the long term to increase the value of that property. So that property do take some negotiations, it do take some due diligence when you're looking for it, and it's not something that you just pick up off the street and you can find it. So it does take you to sort of find the diamond in the rough. But then the next one, what I'm going to show is what happens when you have to do a full refurbishment of a property, what you need to budget in and how to negotiate on something like that, and what's the real difference as well. So until next time, hit subscribe and the bell, and I look forward to seeing you in the next episode. Bye for now.